Netflix is buying Warner Brothers Discovery in an $83 billion deal, but the real winner is not necessarily Netflix. I think the real winner is actually Disney. They're not spending a dime in this, and they're weakening two of their smaller competitors, really solidifying their place in the market. Netflix is the one taking out billions of dollars worth of debt. This is the financing transaction right here. You see $60 billion worth of debt that Netflix is taking on. Now, Netflix is a cash flow positive business. It's the biggest streamer in the world. That position is not going to change. But what is going to change is what the competitive landscape looks like. And I think Netflix is going to get a little bit stronger because of this, but Disney has a much clearer path to winning in both family entertainment and in sports. And that's going to be the key for Disney. I'm going to go through the strategy that I talk about all the time, which is the smiling curve, which explains exactly why this is the case. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. If you want more from me, check out my newsletter, Asymmetric Investing. And if you want to follow my asymmetric investing portfolio without lifting a finger, go to autopilot. The asymmetric portfolio is on autopilot with portfolios like the Pelosi tracker. Now you can follow investors like myself, automatically make trades whenever I make a transaction. So I'll put a link in the show notes and in the comment section. If you want to check out the asymmetric investing portfolio on autopilot, that's a great place to do it. But if you want my full research to do all of that investing yourself, the newsletter is a phenomenal place as well. So great options for all investors. Now, to understand why Disney is the real winner here, we got to go through the strategy behind internet businesses. So this is the smiling curve. This is something I put out on asymmetric investing a whole bunch of times. This is a real thesis behind a lot of the investments that I've made. And that's that on the internet, consumers make choices about who the winners are going to be. And typically, the companies that reach scale are going to be able to have compounding power in not only the number of users that they have, but also the pricing that they can extract from those users. So buyers are choosing who the winners are. That's the real key. They have chosen Netflix. 300 million plus people have chosen Netflix to be a streaming provider. Now, the other end of the scale is niche providers. So an example of that is going to be YouTube. You're watching this video on YouTube. I don't have to build a whole streaming business. I can just put my content on YouTube and use that platform. But what you don't want to be is you don't want to be in the middle here. So I'll go through some examples here to show exactly where you want to be. We want to be in the top right in most publicly traded companies. They're going for scale. The other option is you can be in this top left, but you definitely don't want to be here. You don't want to be a company that doesn't have scale, doesn't have pricing power, and ultimately isn't profitable. So let's look at how this plays out in the streaming business. You can see that Netflix clearly in the top right. They have the most subscribers, the most revenue in streaming. YouTube is the other huge winner. They're actually taking market share from Netflix, but it's a very different business model. It's user-generated content. It's maybe not the same producers of content. So very different, and both of those businesses can be successful. But the other players are the ones that I want to focus on today. So Disney has ESPN, Hulu, and then Disney+. The reason that I think these are important to understand is because Disney is going to be clearly for family entertainment. ESPN is going to be clearly for sports. Hulu is more general entertainment. If you look at Netflix after acquiring Warner Brothers Discovery, they're really doubling down on that general entertainment side. Warner Brothers Discovery doesn't bring a lot of family entertainment, and it doesn't bring any real sports anymore. Remember, they lost the NBA. That's one of the reasons that they're in the trouble that they are today. So it doesn't really help those two areas. That's where I think Disney is going to find a little bit more differentiation. But I really want to focus on these other competitors. So HBO Max obviously comes off the board, but Paramount and Peacock are going to be the other two competitors in the market. So what you want to look at with the smiling curve is who has scale. One of the ways to look at that is the number of subscribers. What I've done here with Disney, they're not actually disclosing the ESPN number quite yet, but they have 205 million plus subscribers when you look at Disney Plus, Hulu, and the old ESPN Plus. HBO Max, a little bit weird the way that they reported things, but 122 million across all of their services. Paramount Plus and Peacock, much, much smaller. But where things really get interesting is when you start looking at pricing, because pricing is going to be a multiplied factor to the number of subscribers that you have. So Netflix is $7.99 per month with ads, $18 a month without ads. So figure that ads business, the spread between those two is going to be about what they're going to be able to generate from ads. Similar thing if you look at Disney Plus, $11.99 with ads, $18.99 without ads. Both of those prices pretty similar. Disney then has the bundle. You can bundle with ESPN, you can bundle with Hulu. That gets you to $12.99 a month with ads with Hulu. So The strategy for Disney is pretty clear. They're trying to bundle all these things together. Netflix is kind of its own bundle. We'll see what happens with HBO, but even HBO doesn't have the same pricing power as you have with the first two. And the real key is the bottom two, Paramount Plus and Peacock, about $8 a month. And if you are a subscriber, if you have been a subscriber of those in the past, you know that you can get it for much lower than that because they're basically desperate for subscribers. And why are they desperate for subscribers? Because they don't have scale yet. They don't have 100 million, 200 million subscribers. So it's a compounding impact. When you look at who's going to have the money to buy rights for the next big film or do the next big sports deal, it's going to be the companies that can take 300 million subscribers times $12, $15, $20 a month rather than 41 million subscribers times $8 a month. The amount of money that these companies have to play with just are not the same. And this is why things compound in the smiling curve. The winners continue to win because they can make their service better, they can afford to buy better content, and the losers just kind of fall by the wayside. So if you look at what happened here today, HBO Max goes away, goes into Netflix. Netflix likely becomes stronger. They're likely going to push their prices higher, whether that's going to be new tiers or just simply raising their prices once a year like they've been doing for the last few years. But the real impact is going to be Paramount Plus and Peacock are in serious trouble. They just haven't reached scale yet. They haven't been able to be profitable. How are they going to be able to afford to sign a deal with the NFL? The NFL has an opt-out right in a couple of years. How are they going to be able to compete with Netflix, Apple, Amazon? They're not. And that's fundamentally going to be a problem for them. So who's the big winner today? I think it's the company that didn't spend a dime to get rid of one of its biggest competitors and makes two of its other competitors even weaker. Now, had Paramount been able to acquire Warner Brothers Discovery and those two combined, now you get to a real third place. Now you have three potential competitors when you look at content rights and who's going to be able to bid for content or bid for sports. That could have been a bigger challenge for Disney. But Disney now has weaker competitors in Peacock and Paramount Plus. Eventually, I think those two will combine, but combining two weak companies with relatively weak libraries, weak sports rights, weak financials, that's going to be much easier to beat those companies, especially now that even Disney's streaming business is profitable. So yes, Netflix is going to be the headline winner here. But remember, Netflix only has about $10 billion in cash coming from their operations, and they already had $14.5 billion in debt before this deal. That's going to now increase to more like $80 billion worth of debt on their balance sheet. Disney, on the other hand, has $18.1 billion in operating cash flow coming from the business. A lot of that's coming from their parks business. We still haven't seen huge improvements from streaming yet because that's just getting to the point where it's operating income positive. And they only have a little over $40 billion worth of debt. That has come down significantly as they paid down debt that was related to buying Fox assets about 6 or 7 years ago. So now Disney has fewer competitors, and their biggest competitor just took on a whole bunch of debt. In a lot of ways, this does make Netflix stronger, but in the areas that Disney cares about most, in family content and in sports, I don't think buying Warner Brothers Discovery's assets does a whole lot to them. In fact, it adds a whole lot of debt and may make it harder to buy some of those sports rights when they do come up over the next few years. So I think if you're looking for a real winner in this deal for Netflix to buy Warner Brothers Discovery, it's Disney. It's just hiding right there. They didn't do anything, and they ended up in a better strategic position. So let me know what you think in the comment section below. What do you think about Netflix stock and Disney stock today? Love to hear your thoughts, and don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.